Good evening, ladies and gentlemen, and a warm welcome to this evening's webinar. While the Chinese technology sector has been a popular means of accessing China's growth potential, the sector has seen a lot of volatility, especially this year. This has possibly led investors to wonder whether the days of growth are over or if there are still opportunities. And if so, where might those opportunities be? In tonight's session, we have with us from IFA Stocks and ETFs research team, Tan Jin, Ferlin Tan, and Heather Lim, who will be on hand to share about the opportunities that still exist, as well as providing an outlook on the Chinese technology sector. To start things off, we'll have Heather to share about the outlook for China's technology sector. Heather, please.
Yep. Good evening, everyone, and welcome again. So I'm Heather from the Stocks and ETF team in IFAS, and let me begin tonight's webinar. As many of you have been following the news, there has been a lot going on in China tech with the almost weekly news and flow on regulations, which never fail to rock markets. And so today, we hope to share our view and offer investment ideas. First things first, we conclude that long-term China tech remains attractive as the long-term mega growth trends remain intact. And I'll be elaborating on these reasons in my presentation. So this is the outline of what I will be sharing tonight, beginning with setting the context of what has happened in recent months and then sharing on why we still like China tech. So to begin with all that has happened over the year, many Chinese tech stocks have tumbled to their year-to-date low, with Hang Seng Tech falling 50% since their highs in February. The train of regulatory crackdowns began late last year with the cancellation of Ant Group's IPO and has intensified in recent months. So just to highlight some, in March, tech giants including Meituan and Pinduoduo was fined for price dumping, selling goods below cost. Alibaba was later slapped by regulators in April with a record fine of $2.8 billion for violating antitrust law, as the company has been imposing the exclusivity contracts on merchants. The crackdown heightened in July, which included a government ban on Tencent Music from owning exclusive rights in the online music industry. Also in July, there was the announcement where it required all private education institutions to register as non-profit. In August, gaming stocks took a hit when regulators announced a new rule that limited game time to between 8 to 9 p.m. only on Friday till Sunday for players under 18. And this was followed with regulators also calling Tencent and NetEase for a discussion regarding further oversight of the gaming industry and also the emphasis on profits. However, we think that the fears of increased regulation are largely overblown, and here are the 4 reasons why, which I will be elaborating on now. First, we think that China has legitimate reasons to regulating big tech as they have grown significantly over the years and wield immense power. Despite the dominance of these companies, they have not been regulated, with nearly zero antitrust scrutiny since their founding. If left unchecked, power will remain in the hands of these internet platforms, allowing them to unfairly treat both merchants and consumers, such as true price discrimination, where consumers can be charged different prices. Also, in the case of the 2-choose-1 exclusivity practice, merchants must be exclusive to a certain platform, which limits the merchant's customer reach. Furthermore, with the monopolistic power, the lack of competition will impede innovation in the industry. Hence, we believe that a healthy dose of regulation on the sector is justified. Moreover, these regulations are in line with the regulators' emphasis that they are not trying to stifle the growth of tech companies, but rather to safeguard consumer interests and ensure sustainable growth of the sector. Additionally, big tech has also created certain social ills, such as education inequality and poor working conditions. So in the case of the edtech sector, if the government did not intervene, education inequality would be worsened, as only the rich will be able to afford private tutoring. Moreover, the high cost of raising a child in China, including forking out great sums to help children successfully navigate the Gaokao, really disincentivizes families from having more children, which would worsen China's aging population woes. So on the labor side, the poor working conditions, such as the toxic 996 working culture, is common in the tech sector, with many employees suffering burnout from overwork and also not compensated for these overtime hours. Additionally, in the informal labor economy, working conditions are also not good for the delivery riders. Not only are they overworked and underpaid, but the tight deadlines that they have has forced them to take dangerous routes, resulting in several injuries and deaths. Hence, with these social ills, it is not difficult to understand why China's authorities are imposing the regulations. Next, we also want to highlight that China is not the only country that is trying to regulate big tech companies. As in US and Europe, we also see activists and policymakers calling for greater regulations on tech companies. For example, in the case of Google, there was a lawsuit filed by Justice Department in October last year, highlighting and alleging that Google uses exclusivity contracts to maintain its monopoly in search. In the case of Facebook, the FTC also filed a lawsuit alleging that the company is illegally maintaining its social networking monopoly through anti-competitive conduct. The difference is that China has executed regulations much faster. It only took less than 4 months of antitrust investigations for Alibaba to be slapped with a fine in April this year, while for the case with Google, it will only go in trial in September 2023. So bringing the first two reasons together, we believe that the regulations are justified and that China is not the only country. And we believe that these steps taken to regulate tech companies are a step in the right direction. Nevertheless, the regulations will impact companies, but we think that the impact will be uneven, with some companies benefiting, some remaining resilient, and some that are hard hit. So first, we are most pessimistic on companies whose earnings will be directly affected. For example, in the Private Education Act crackdown, the move to make private tutoring more affordable and even non-profit calls into question the viability of the private tutoring business model. And we think that it could result in these companies losing a huge chunk of their profits. On the other hand, some companies will remain resilient. An example would be Tencent Music. So although Tencent Music will no longer be able to have exclusive rights to music licenses, we believe that they will still be able to maintain their strength in customer retention and acquisition. Why so is because they have a strong ecosystem on their WeChat platform, which has 1.24 billion monthly active users, which creates user stickiness across the platforms. Some companies may even benefit from the regulations, such as in the case of JD.com. So why so is because that with the crackdown on the exclusivity contracts, it will level the playing field for e-commerce companies, as merchants no longer need to be exclusive to a single platform. And since the crackdown in April this year, JD has seen the return of brands such as Starbucks and Victoria's Secret to its platform. Additionally, JD's business is aligned with government goals and hence can be a beneficiary amidst this changing regulatory landscape. And this is because JD is a pioneer in smart supply chain, which aligns with the government goals of modernizing and upgrading the supply chain infrastructure. Additionally, in other segments, we also think that companies in sectors that the government continues to invest in will do well, such as in semiconductors, AI, 5G, and cloud, which Terjun and Falin will be elaborating on later. Finally, we continue to like China tech for the long-term growth trends. The first trend is that there is a growing number of internet users. China continues its digital shift and has even accelerated during COVID, as seen in the chart, where internet penetration rate in China was up to a record high of 70.4% in 2020 and is the largest annual jump. Despite that jump in penetration last year, China's internet market remains far from saturated, with its penetration rate still lagging behind peers such as North America and Europe. Besides the rising internet penetration rate, another mega trend supporting the growth of China's tech sector is the digitalization of consumption. So in present-day China, consumption of goods and services has become increasingly digitalized as people are more willing to pay for the convenience of on-demand services such as e-commerce, food delivery, and ride-hailing. We see this trend in how e-commerce has experienced significant growth over the years, becoming a larger percentage of total retail sales. So in 2020, online sales accounts for 25% of the total retail sales in China, more than doubling from what it was 5 years ago. Even in the midst of the regulatory crackdown, e-commerce activity remains robust. Across the first half of 2021, the two largest e-commerce players, Alibaba and JD, demonstrated continued strength in revenue growth over 2021, as seen in the chart. This reinforces our confidence in these long-term megatrends as long-lasting growth drivers for the tech sector. In addition, these first-half numbers also paint a picture that shows the spike in demand for digital services caused by COVID is here to stay and not just a temporary surge. And so we believe that the consumer behavior shift continues to be shifting online. So to sum up the reasons why we continue to remain positive on the China tech sector, We believe that first, regulations are justified and the impact will be uneven, with some companies benefiting while others disadvantaged. Moreover, we believe that the long-term megatrends of rising internet penetration and further digitalization of consumption continues. Hence, the recent dip in share prices gives investors opportunity to gain exposure to the sector. However, investors must be ready to stomach the near-term volatility in share price, and we recommend a diversified strategy. Investors considering a diversified portfolio can consider the iShares Hang Seng Tech ETF, which is our recommended ETF. So our target price for the iShares Hang Seng Tech ETF is 19.4 Hong Kong dollars, which gives investors an attractive upside of roughly 50% based on the closing price of 13 Hong Kong dollars as of 21st September. With that, I've come to the end of my presentation. Thank you.
Hi, good evening, everyone. My name is Jun, and welcome again to tonight's webinar. So earlier, you have already heard my colleague discuss about China's tech sector, the recent regulatory crackdowns, and the impact that they have on Chinese tech companies. So needless to say, I think many investors are becoming increasingly worried about the future of China tech companies, and some of you may even be wondering if Chinese tech stocks are still investable at this point in time. So before I begin, I would like to reiterate our view that our general view is that the long-term growth story of China's tech sector remains strong. That despite the harsh regulatory environment, we believe that there are still certain segments of the tech sector that could perform well. So over the next 15 minutes or so, I will be taking you guys through one of these segments, which we think has the potential to not only do well in the current environment, but also in the long run. And this segment is China's semiconductor industry. So for the benefit for those of you who are not familiar with the semiconductor industry, I'll do a quick introduction to get you guys acquainted before diving into the China semiconductor industry itself. So semiconductor products are made from materials such as silicon, and they are essential components that make every electronic device work. So there are many different types of semiconductor products such as CPUs, which does all the computing, logic work, memory, which allows you to store data such as photos, and even image sensors, which converts the light captured by the camera lens into a digital signal so that your photo can be stored. So the companies that operate in this industry, they generally belong to one of three main groups. So in the first group, we have what we call the pure play foundries. So these are companies that do not have any design capabilities, as they focus only on the fabrication and the testing of semiconductor products. And in the second group, we have fabless companies. So fabless companies, they are involved only in the design and sale of semiconductor products while outsourcing the fabrication to foundries. And last but not least, we have what we call the integrated device manufacturers, or IDMs in short. So IDMs, they basically do everything, both the design as well as the fabrication of semiconductor products. So together, these companies design, manufacture, and sell a variety of semiconductor products that eventually find their way into items that we use on a daily basis, such as your smartphone, your computer, the TV, or even your car. So now that you have a better understanding of what the semiconductor industry is all about, let's talk about China. So since the very beginning, China has not had a significant presence in the global semiconductor market. In 2019, the country only accounted for just 5% of the global semiconductor market, which is far behind the US and South Korea, which controlled about 47% and 19% of the market respectively. And the main reason why China has such a small market share in the global semiconductor industry is because of technology. In terms of chip design, China has made significant progress over the years, with leading fabless companies like HiSilicon able to design advanced chips, which are used in applications such as 5G and AI. For instance, HiSilicon's new line of smartphone processors are considered to be on par with those that are designed by Apple. So where China is lacking the most is foundry technology. So for decades, China has long struggled to produce its own semiconductors, especially those that require a cutting-edge manufacturing process. So SMIC, its most advanced foundry, only began producing chips using a 14 nanometer process back in the fourth quarter of 2019. And it is a feat that rival TSMC has managed to achieve 5 years ago. And within a short span of a year, this technology gap has widened even more, with TSMC introducing its 5 nanometer process in the first half of 2020. And besides TSMC, SMIC's technology is also several generations behind those of other foundries, such as Global Foundries as well as Samsung Foundry. So despite being the largest electronics manufacturing hub in the world, domestic production only accounts for roughly 20 to 30% of China's total semiconductor demand. Its limited technological capabilities means that China has no choice but to fulfill the remaining demand by importing from other countries, which is mainly the US. And in 2020, China's chip imports reached a record high of 380 billion US dollars, a number that has been increasing every year as global demand for electronics continues to rise. But with the US clamping down on China's access to these critical components, Chinese companies now realize that they can no longer safely rely on imports and will eventually have to start looking inwards to meet their semiconductor needs. The huge amount of chips that China imports every year, it is a tremendous market opportunity for local semiconductor companies. And looking ahead, these companies will stand to gain thanks to the greater domestic demand as well as the government's push to localize chip production. So since the US-China trade war started in 2018, the relationship between both countries has deteriorated substantially. And over the past 2 years, this conflict has actually extended to a number of issues beyond trade, such as intellectual property theft as well as national security. Right now, national security, it seems to be the #1 priority of the US as it has implemented a string of measures over the past 2 years in an attempt to hamstring the growth of China's leading technology companies, starting with Huawei. So back in May 2019, the US Commerce Department announced that it has placed Huawei as well as 68 of its affiliates on the entity list, claiming that the telecoms equipment manufactured by Huawei can actually be used for spying, and therefore it poses a national security threat to the US. So this effectively restricts Huawei's ability to purchase vital components like semiconductors from US firms to manufacture its products. And from then till now, many other Chinese tech companies have fallen into the crosshairs of US regulators. And if these companies, they are unable to find an alternative supply for their chips, operations can be severely affected. So in response, Chinese officials, they started accelerating plans to strengthen the country's semiconductor industry. And as part of its Made in China 2025 plan, China aims to produce about 70% of all the semiconductors it requires by 2025. And with its longer term goal is to become completely self-sufficient. So given how crucial semiconductors are to a nation's development, we think that the bans will have the opposite effect of compelling China to double down its efforts in building up its semiconductor industry instead of slowing the rise of China's tech sector. So the recent events have revealed China's vulnerability in this key sector, and we think that China will be very keen to fix these issues. So the road to self-sufficiency will definitely be paved with difficulties, but we believe that China will persevere through as the future of the nation depends on the success of this endeavor. And to achieve its goal of becoming self-sufficient in chip production, the Chinese government has laid out several policies to support the industry. So one of its greatest efforts is to establish a national fund to help promote the growth of the local semiconductor industry. So this fund, which was first set up in 2014, has invested close to 350 billion in various projects and companies within China's semiconductor industry to date. And it is estimated that roughly 67% of the monies went to manufacturing firms, which include both your integrated device manufacturers as well as your foundries. And this actually demonstrates the government's priority of building up the nation's chip-making capabilities. Secondly, the government has also made significant adjustments to its tax policies last year, which is a decision that should greatly benefit local semiconductor companies. So under this new policy, chip makers that have been in operation for at least 15 years and produce chips using a process of 28 nanometers and below may be exempted from paying corporate income taxes for up to 10 years. So these tax benefits, they also extend to other companies, such as those using mature processes, fabless companies, materials, and equipment firms, as you can see from the table on the screen. So the idea here is that by reducing the tax burden, these companies, they will have more resources to allocate to capital expenditure as well as to research and development, which will hopefully improve their technological capabilities and allow them to compete with their Western peers. And again, through the way these policies are structured, we can clearly tell that the government's focus is on strengthening the country's chip-making capabilities, which is an area that it is currently lacking the most. And with the motivation as well as the resources to narrow the gap between themselves and the US, we believe that China's semiconductor industry is about to enter a phase of supercharged growth, one that will bring about many investment opportunities in time to come. So investors who are interested in this segment, you can consider SMIC, which is the largest and the most advanced foundry in mainland China. So SMIC, it is China's national champion in the semiconductor industry, and it is widely expected to lead the nation's chip-making ambitions. In 2020, the company's revenue rose by nearly 30% on the back of rising domestic demand, which is a trend that is expected to continue as China pushes towards self-sufficiency. Moreover, in its latest earnings call, the company has also raised its full-year revenue growth target by 30% for 2021, which was originally in the high single digits. And on top of that, SMIC is also one of the few companies that meets the criteria for preferential tax treatment, which could allow the company to pay significantly less taxes over the next 10 years. So the combination of these factors will likely mean that the company will see earnings grow significantly over the next few years, which is, of course, a key catalyst that could drive share prices upwards. And based on our estimates, we think that SMIC shares have an upside potential of about 43%, and that translates to a target price of about 32 Hong Kong dollars. Alternatively, investors who prefer a more diversified approach to investing can consider investing in the Global X China Semiconductor ETF, which is our recommended ETF for exposure to China's semiconductor industry. So this ETF, it seeks to replicate the performance of the FactSet China Semiconductor Index, which consists of a basket of 24 Chinese semiconductor companies. It also counts SMIC as one of its top 10 holdings. So this ETF has a healthy liquidity profile, which helps to lower the implicit cost of entering or exiting positions. On top of that, it also has a relatively low expense ratio of just 0.68%. And another advantage of this ETF is that it provides investors with exposure to semiconductor firms that are listed in mainland China, which shares may not be easily accessible to certain investors. And to top it all off, using an ETF such as this will also help to minimize any company-specific risk, and it's a good alternative compared to investing in single stocks, especially for investors who are not confident in their stock picking skills. And for this ETF, we have a target price of 77 Hong Kong dollars, which represents an upside potential of approximately 24%. And to sum things up, we think that there are many reasons to be positive about China's semiconductor industry: strong state support, rising domestic demand, as well as the government's plan to localize chip production and the potential removal of US sanctions are factors which could drive an upward re-rating in the share prices of Chinese chip makers. And with that, I've come to the end of my segment. I hope that through this session, you are able to gain a better understanding of China's semiconductor industry, its growth prospects, and more importantly, why we think it has the potential to do well in the long run. So once again, my name is Terchit. Thank you all for being here today, and I wish you all the best in your investing journey. And I'll now hand the time over to my colleague who will share more about our stock picks for China's hardware industry.
Okay, hi. So good evening, everyone. My name is Felin. I'll be wrapping up tonight's webinar. So for my part, I'll be focusing on China tech hardware industry, where we will be sharing two of our stock picks. So the first company I'll be sharing is Sunny Optical, which is one of the top 10 holdings of our recommended China tech ETF shared by Heather earlier. So Sunny Optical, it is a company that manufactures and supplies camera lenses and modules to its customers. And as of its 2021 interim report, it generates majority of its revenue from supplying smartphone-related camera lenses and modules. So Sunny Optical is a major player in this smartphone camera industry, where it is currently the world's largest supplier of handset lens, and it is also the world's second largest supplier of handset camera modules. And also, Sunny Optical is the world's largest vehicle lens supplier, which is something that I will share more about later on. Now, let us first discuss more about its smartphone business segment. So, smartphone cameras have come a long way since their introduction, and in today's battle of the smartphones, camera technology has become the largest battleground for smartphone manufacturers, where many of them are using photography as a point of differentiation for their brands. And at this point in time, multi-camera is no longer something new. Most of the flagship phones have upgraded from single camera system to triple camera system over the past few years. And in fact, many of them are going for quadruple camera or even like 5 camera system nowadays. So therefore, while acknowledging the slowdown in camera upgrades in the near term, the management remains optimistic about the multi-camera upgrade cycle in the longer term and believes that the camera upgrade cycle is likely to resume by 2022 or 2023. And at the same time, smartphone brands are also demanding for more sophisticated optical systems. So therefore, on top of higher shipment volumes, this also suggests room for margin improvement as higher quality camera lenses and modules command a higher average selling price, which will boost Sunny Optical's overall gross profit margins and earnings. Next, transition to 5G networks will also drive Sunny Optical's smartphone camera lenses and module shipments. So new hardware is needed to support this latest cellular technology. Therefore, as the 5G networks are slowly rolled out to the market, new smartphones will be required to make use of this technology. And when there's new smartphones, this also means new cameras. So something we'll share here, which is that Huawei was once a key customer of Sunny Optical, but due to the Huawei ban that was imposed more than a year ago, Huawei has actually lost quite a significant amount of market share. But before you start worrying, I think it's important to know that Sunny Optical also has established close business relationships with other Chinese smartphone brands such as Xiaomi, Oppo, Vivo, all of which have been gaining market share over the years. And on top of that, Sunny Optical has also recently entered Apple's supply chain, and it will most likely be responsible for its upcoming iPhone 13 camera lenses. So therefore, as more new smartphones with new upgrades are rolled out, Sunny Optical will become one of the main beneficiaries given its status as the world's largest smartphone lens and the world's second largest smartphone camera module supplier. Now, moving on to its vehicle lens business. And like what we have shared earlier, not only is Sunny Optical the world's largest player in the handset camera lenses market, but it is also the world's largest player in the fast-growing vehicle lens market. So as the market leader, Sunny Optical is in a good position to grow their vehicle lens business as the demand for vehicle lenses is expected to continue its growth. So this will be driven primarily by the development of autonomous vehicles, as well as the increasing government regulation worldwide emphasizing on vehicle and driver safety, which will in turn drive demand for ADAS solutions, which is also known as Advanced Driver Assistance System solutions. So they are basically electronic systems designed to help drivers to reduce accidents and ensure better road safety. So some examples include like blind spot detection system, collision warning, and braking systems. And more importantly, cameras are the key component of majority of the ADAS solutions. And at this juncture, Sunny has a strong product pipeline for its vehicle business, which underscores its strong earnings visibility over the next few years. Generally, Sunny Optical has managed to secure several new project wins. And at the same time, it also has several projects expected to enter mass production in the next 1 to 2 years. And thanks to its first mover advantage and technology leadership, Sunny Optical has managed to establish strong relationships with the tier 1 car component suppliers and several global ADAS platforms, which will allow Sunny Optical to benefit from the strong growth in vehicle-related shipments in the coming years as more ADAS solutions are commercialized and adopted by car manufacturers. So overall, we favor Sunny Optical, and we believe that it is well positioned to take advantage of the long-term trends as mentioned earlier, such as the multi-camera upgrade cycle, the transition to 5G networks, as well as the development of autonomous vehicles. And based on our fair PE, our target price translates to about 250 Hong Kong dollars. So the recent sell-off in the market presents an opportunity for investors who are interested in Sunny Optical. And of course, we continue to hold a positive view on this company. Now, the next hardware stock idea we would like to share is Xiaomi. So Xiaomi is currently the world's second largest smartphone manufacturer in terms of shipments. And something interesting to share is that it has recently set a new goal, which is to dethrone Samsung as the world's #1 smartphone maker within 3 years. Now let's try to understand Xiaomi's business model. So we know that Xiaomi is a smartphone manufacturer, but besides selling smartphones, the company also operates in other fast-growing business segments. And the first one is the Internet of Things and lifestyle products, also known as the artificial intelligence of things. So this is where Xiaomi sells smart TVs, smart watches, and many other smart devices. And as the company strives to sell value for money products, it has pledged to cap the net profit margin of hardware at 5%. And meanwhile, the company also enjoys much higher margins from the internet services segment. The majority of revenue from the internet services is generated from advertisements displayed on Xiaomi's self-developed mobile applications. So our first investment catalyst, to drive its core smartphone business, Xiaomi will be focusing on growing its shipment volume, especially in the premium smartphone market. So Xiaomi first started selling their premium smartphones in 2016, and since then, the company's premium smartphone portfolio has become one of the main drivers of its overall smartphone shipments. So in the first half of this year, Xiaomi has shipped 102 million units, which is 73% higher year on year, as the company feels the void left behind by Huawei and continues to expand its business overseas. So Xiaomi has also recently launched a new premium smartphone called the Mi X4, which we believe can support shipment volume in the near term. So next, we also believe that there's further room for growth in mainland China and Europe. So even though Xiaomi is ranked #2 globally, it is currently not the largest smartphone maker in its home market. As shown by a table, Xiaomi is still lagging behind Vivo and Oppo. So one main reason for this is because as compared to those two companies, Xiaomi offline sales channel is still in the early stages of development. And as a matter of fact, its offline market share is only 7.8%. So with a less developed offline sales channel, Xiaomi has less presence in the lower tier cities where consumers there actually prefer to feel and touch the smartphone devices before making their purchase decisions. So as such, in order to compete with these local rivals, Xiaomi is expanding its footprint in every county across mainland China with a target of 10,000 retail stores by the end of this year. So the company's expanding offline presence can help it to sell phones which the online channels cannot cover, hence translating into higher smartphone shipments moving forward. And apart from mainland China, there's also great potential in Europe. So besides the online and offline stores, smartphone sales can also be generated from carrier channels. So carrier channels refer to telcos, and some of the biggest players in Europe include Vodafone and Orange. So while market share in carrier channels has been on the rise, it is still considered small. So supported by increasing collaboration with carriers in Europe, Xiaomi smartphone shipment in Europe is anticipated to grow strongly. Finally, other than smartphones, the remaining business segments of Xiaomi are also very important. So for its artificial intelligence of things business segment, all of these devices can be seamlessly connected by the Mi Home app, and this has led to increased user stickiness. So as shown by the chart on the left, you can see that more and more users own at least 5 or more of Xiaomi's AIoT devices. So unsurprisingly, Xiaomi holds the market-leading position in mainland China for AIoT, and the management expects the continuous penetration of Xiaomi's AIoT products in overseas market to be a key driver of the segment's growth. So next would be its internet service segment. Xiaomi is strengthening position in the premium smartphone market will drive a growth in user base for its internet services, which will in turn drive the earnings growth for this segment. And given the high margins of the internet services business segment, this would be an important driver for the company's long-term margin expansion. And on top of that, all of Xiaomi's business segments interact to form an ecosystem. So for instance, the sale of hardware provides cross-selling opportunities for the internet services segment, And generally, it seems that the ecosystem strategy has been paying off, where we see that the internet services average revenue per user has been on uptrend since 2015. However, there was a slight decline in recent years due to a soft mainland China advertising market, the impact of COVID-19, as well as India's ban on Chinese apps. So nonetheless, with the recovery of advertising spending, as well as a growing user base and more user monetization opportunities from premium smartphones, we do expect to see an uplift in the ARPU moving forward. So as Xiaomi can acquire and retain users through the sale of hardware, it enjoys lower customer acquisition costs, which may translate to better profit margins in the longer term. So overall, based on a fair P of 25 times to our estimated 2023 earnings per share, our target price for Xiaomi translates to 38 Hong Kong dollar. And this represents an upside potential of 67% as of the 20 September's closing price. So to sum things up, we believe that Xiaomi focus on premium smartphones and the growth in mainland China and Europe will translate into strong smartphone shipments in the years to come. And at the same time, once again, the stickiness of its AIoT devices, along with its internet services segment that enjoys low user acquisition costs, could propel the company's growth even further. So here we have the summary of our product recommendations for the China technology sector. So if you prefer to do stock picks, you may consider SMIC as shared by Dejun, or the two hardware stocks that I have shared earlier. If not, we believe that you can also consider investing through an ETF instead for diversification purposes. And on the screen are our two recommended ETFs to invest in the overall China tech sector and China semicon industry. So finally, before we move on to our Q&A session, we just want to take this opportunity to share with everyone our thematic portfolio, something new which is designed to provide you with stock and ETFs ideas under certain mega trends. So for those who are unaware, our thematic portfolios, they seek to identify and capitalize on long-term mega trends that will transform the world tomorrow. Our portfolios are also built on innovative ideas that will allow you to participate in some of the world's most promising investments, and also to provide diversification to an overall portfolio. So for each portfolio, we will identify what are some of the industries that will benefit under each trend before we analyze and sift through the data to target the companies that are superior based on our in-house rule-based methodology. And just to zoom into one particular portfolio that I think is most relatable to today's session, which is the digitalization of consumption. So not only is global consumption growing, but consumption habits are also increasingly digitalized. So both buyers and sellers are shifting their presence online, which suggests that we are going to witness high e-commerce adoption rate across the world as we shift away from traditional retail. So the shift in consumption patterns present many opportunities for a wide spectrum of companies. So firstly, we identified that companies in the e-commerce business will be one of the main beneficiaries as consumption becomes increasingly digitalized. So additionally, for businesses and services to go digital, payments will have to be made remotely as well. Therefore, we also see huge growth opportunities in the online payment system space. Another two important industries along the e-commerce value chain are the storage, the storage and delivery. Demand for warehouse storage space has been on the rise given the increasing need for a centralized distribution center. Doorstep delivery is also becoming one of the core functions of e-commerce, making delivery services the fourth most important industry that will benefit from the rise of e-commerce. So now that we have identified the industries, we will apply our in-house rule-based methodology to select up to maybe 20 securities for each portfolio. So the selection process focuses on a wide range of financial metrics, which include profitability, balance sheet strength, cash generating power, valuations, and etc. So ETFs from our ETF focus list will also be selected for each portfolio. So for example, here we have the stocks and ETF ideas for investors who wish to gain exposure to the digitalization of consumption thematic portfolio. So we have also enhanced our thematic portfolio page to incorporate a set of portfolio metrics that may be useful for your investment journey. So this includes like the 3-year price chart, total price return over the last 3 years, forward P ratio for PB, as well as the forward dividend yield. So overall, thematic investing to us is not a simple sector focus or factor focused investment strategy. And we believe that it is a long-term and forward-looking investment approach that seeks to profit from the large-scale forces that will change our world. Finally, we have reached the last slide, and here are the relevant investment tools that we believe will be useful for you. So we have the thematic portfolio, which can serve as an idea generation page. We also have our ETF focus list, where we have chosen what we deem as the best ETF for each category. And finally, you can also join our research highlight Telegram chat as shown in the QR code on the screen, where we'll be sharing our latest stock or ETF or fund ideas, as well as any macro updates in bite sizes. So this would be great for those who don't really have time to read our full article, but still wish to know the summary points of each of our stock or like fund ideas. So with that, I come to the end of my part. Thanks for everyone for joining tonight.
Hey, thank you, ladies and gentlemen, for all your kind attention and your participation this evening. We hope this session has been fruitful for you. Do stay tuned to fsm1.com as we continue to provide you more updates, as well as investing ideas. So we wish all of you a good health and a successful investing journey.